Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about Chapter 1 of Module A of International Banking, Exchange Rates and Foreign Business. Now in this chapter, we are going to learn the definition and types of exchange rates, the mechanism and the market, the factors affecting rates, the related guidelines, how a dealing room operates, Forex operations in India. Now, the export of goods manufactured in India to USA are paid in US dollars, where the exporter needs to convert the US dollar into Indian rupees. Similarly, import of capital goods from Germany to India billed in euro is to be paid in euro by converting Indian rupees into euro. Now, this conversion of currencies from the currency of invoice to the home currency of the exporter will generally require for cross-border trade. Now, this is called foreign exchange. So, for Indian exporter or the importer, the US dollar or euro is the foreign exchange. Now, exchange has become an integral part of world financial system. Now, foreign exchange definition. Now, if you talk about definition, under the Foreign Exchange Management Act FEMA 1999, Section 2 defines the foreign exchange as all deposit, credit, and balances payable in foreign currency, and any drafts, traveler checks, letter of credit, and bill of exchange expressed or drawn in Indian currency and payable in any foreign currency is foreign exchange. Now, foreign exchange transaction is a contract to exchange funds in one currency for funds in another currency at an agreed rate and arranged basis. The price or the ratio or the value at which one currency is exchanged for another currency. Now, the currency rate is dynamic rate which varies from day to day, minute to minute, in fact, second to second, depending upon various factors. Now, if we talk about foreign exchange markets, now foreign exchange markets comprise a large spectrum of market participants, which include individual business entities, commercial and investment banks, central bank, cross-border investors, arbitrators, speculators across the globe. It's a communication based market with no boundaries and operates around the clock. It is not bound by any wall or brick or mortar. Forex markets are dynamic markets and work around the clock in different time zones. Now, the world currency market is a very large market with large number of participants. Major participants of foreign markets are central banks, commercial banks, investment fund banks, forex brokers, corporations, and individuals. Now, participants not only use the forex market for trade or travel purpose but also for investment, hedging, and speculative activities, thus generating large volume of the market. Now, 98% of the global forex market trading relates to investments or speculative trading. The Indian forex market too trades over 34 billion per day. The forex markets are highly dynamic, which fluctuate at every 4 seconds. It registers 21,600 changes in a day. Now, forex market usually operates from Monday to Friday globally. The bulk of forex markets are over the counter, meaning that the trades are concluded through telephone or other electronic systems. Thus, the characteristics of foreign exchange is that it is a 24-hour market, it's an over the counter market with well exchange driven market, a global market with no barriers, no specific location, a market that supports large capital and trade flows. It's a highly liquid market, high fluctuations in currency rates, settlement affected by time zone factor, markets affected by governmental policies and controls. Now, if I ask you certain questions, I hope you'll be able to answer these questions in the description box below. Question number one: the term foreign exchange is used to donate dash as well as dash of one currency into another. Question number two: the exchange rate of major currency fluctuates every dash second. The forex markets are dynamic and round the clock market, whether this statement is true or false. Forex markets are not affected by government policies, whether this statement is true or false. A large part of total global forex turnover results from global commodities trade, whether it's true or false. Now let's talk about the factors determining exchange rates. Now let's first talk about the fundamental reasons. The other is technical reasons. So first we'll talk about fundamental reason. Balance of payment. Now normally a surplus leads to stronger home currency while deficit weakens the same. Economic growth rate. A high growth rate leads to rise in imports and fall in value of home currency. Fiscal policy. An expansionary policy, example low tax, can lead to higher economic growth. Monetary policy. It's the way the central bank attempts to influence and control interest and money supply, which can impact the value of currency of the country. Interest rate. High interest rates slow the economy down, thereby weakening the currency. Political issues. Now, the second are the technical reason. Now, capital normally tends to move from lower yielding to high yielding currencies and result in movement of exchange rates. Third is speculation. Now, speculative forces can have a major effect on exchange rate. Speculation deals provide depth and liquidity to the market and at times act as a cushion too. Now, if we talk about the exchange rate mechanism, let us talk about some important factors which you should definitely know. Now, types and calculation. Now, most of the forex deals are done on spot basis, meaning the delivery of funds takes place on the second working day. So, whenever someone says that word spot basis, this means the settlement of funds is going to take on the second working day. Now, the rate at which these deals are done is known as spot rates. Now, spot rates are the base rates for other foreign exchange rates. The date of delivery of funds on the date on which the exchange of currencies actually take place is also referred to as value date or settlement date. So, the date on which the settlement take place is known as value date. The delivery of foreign exchange deals can be settled in one or more of the following ways. Now, what are the different ways in which it can be settled? First is ready or cash. Now, settlement of funds takes place on the same day, that is the date of the deal. Then it is called ready or cash. Tom, settlement of funds takes place on the next working day of the date of deal. For example, if today is 22nd of April, if the settlement takes place on 23rd of April, it is called Tom. That is next working day. Saturdays and Sundays should be excluded. Third is spot. Now, settlement of funds takes place on the second working day after the following date of contract deal. If the date of spot is 3rd April 2019, the settlement date will be 5th April 2019. Now, what is forward? Delivery of funds takes place on any day after the spot day. So, spot days is 2 days after the deal is done, and forward rate is any date after the spot date. For example, if the forward deal is for 30th of April 2019 and for value settlement date is a forward deal. So it can be any day after the spot date. Now let's talk about spot and forward rates. Now in forex market, all rates are quoted generally in spot rates, which is settled on the second working day. We have already learned this. The volume depth Depth and volatility of the spot market is higher due to larger participation of market players in the spot trades. Now, on the other hand, when the delivery of the currencies is to take place at a date beyond the spot date, which is beyond 2 working days, then it is a forward transaction. We have also learned this, and the rate applied is called forward rate, which is generally different from the spot rate. Now let's talk about forward margins, premium or discount. Now forward rates are derived from spot rates and a function of spot rates and forward premium or discount of the currency being quoted. So forward rate is spot rate plus premium or minus discount. So if the forward value of home currency is more than that being quoted for spot, then it is said to be a premium. While if the home currency is cheaper on for a forward date than spot, then it is called at a discount. The forward premium and discount are generally based on the interest rates differential of the two currencies involved, as also on the demand and supply of forward in the market. Therefore, the forward price of a currency against another can be worked out with the following factors. First, spot price of the currencies involved. Second, the interest rates differentials for the currencies. Third, the term, that is the future period for which the price is worked out. Now let's talk about direct and indirect quotes. Now under direct quote, the local currency is variable, such as 1 US dollar, which is a foreign currency, is equal to 68.10 rupees. So the rates are called direct as the rupee cost of foreign currency is known directly. So when we are quoting our, that is local currency rate at a fixed foreign currency, it is called direct rate. So 1 US dollar is equal to 68 rupees. This is direct quote. On the other hand, under indirect method, the local currency remains fixed while the number of units of the foreign currency varies. For example, rupees 100 is equal to 1.5 US dollar. In this, our local currency remains fixed. This is indirect quote. Okay. Now, only in case of pound, euro, Australian dollar, and New Zealand dollar, the currencies are quoted as indirect rates. Otherwise, every time it is quoted as direct rate. Let us get this point clear again. Only in case of pound, euro, Australian dollar, and New Zealand dollar, the currencies are quoted in indirect rates. Okay. Now, what is cross rate? Now, when we deal in the market where rates for particular currency pair are not directly available, the price for the said currency pair is then obtained indirectly with the help of cross rate mechanism. So if US slash INR is 68 slash 11 and pound slash USD is 1.2 slash 10, then pound slash INR rate we need to cross multiply on both the sides, and whatever answer comes is that rate, cross rate. Now let's talk about fixed and floating rates. The fixed exchange rate is the official rate set by the monetary authority for the currencies. So fixed rate is set by the monetary authorities. Under floating exchange rate, the value of currency is decided by the supply and demand factors. This is important. So fixed rate is determined by monetary authority and a floating rate is determined by the supply and demand of that particular currency. So since 1973, the world economies have adopted floating exchange rate. India switched to floating exchange rate regime in 1993. So this is something which we should definitely know. Now bid and offer rate. Now buying rates and selling rates are also referred to as bid and offer rate. So when we talk about buying rate, it is bid rate. B and B, buying, bid. And when we talk about offer rates, it means selling rates. So I hope this is easy to understand. Now value date, this is the term used to define the date on which the payment of funds takes place. We have already discussed this. Arbitrage. Now, arbitrage consists of simultaneous buying and selling of commodity or currency in two or more markets to take advantage of temporary discrepancies in prices. For example, there are two exchanges, one in India and one in, let's suppose, Japan. And there is a slight difference of US dollar in both these markets. So the people who speculate, who do arbitrage, they will take advantage of this small difference and they will invest the money in which they'll be getting a better rate and hence earn a lot of profit. So purchase of one currency for another accompanied by almost immediate sale against the same currency in another center. This is called an arbitrage transaction. Okay, let me ask you certain questions. I hope you'll be able to answer them in the description box below. Question number 1. Main factors affecting exchange rates are technical, dash, and speculation. So what are the three major factors affecting the exchange rate? We have already discussed this. Question number 2. In a spot contract, settlement of funds takes place on the dash working day following the date of contract. Question number 3. If the currency is costlier in forward, it is said to be at dash. Question number 4. If the forward value of the currency is cheaper, it is said to be dash. The date of settlement of fund is known as dash date. The rate at which the quoting party is ready to buy the currency is called dash rate. Okay. Foreign exchange dealing room operations. It acts as a separate profit center for the bank and institutions. Now we will talk about the foreign exchange dealing room operations. Now a dealer has to maintain two positions. This is important to understand. One is fund position and the other is currency position. Now the fund position reflects the inflow and outflow of funds. That is amount of receivables and payables. So any mismatch in the receivables and payables will throw open interest rate risk in the form of possible overdraft, interest in nostro accounts or loss of interest income on surplus credit balances. So there are two positions which the dealer has to maintain. One is fund position and other is currency position. In fund position, we see the inflow and outflow of funds which has to be maintained. Now let's talk about currency position. It deals with the overbought and oversold positions. So many a times the currencies are overbought or oversold. So the currency position will see this. It will be arrived after taking various merchants or interbank transactions and the dealer will be concerned with the overall net position which exposes the dealer to exchange risk from the market movements. The dealer has to operate within the permanent limits prescribed for the exchange position by the management. Now, in the other part of the dealing room is the back office. Now, back office takes care of the processing of deals, accounts, and reconciliation. So, back office acts as both supportive as well as checking role over the dealers or dealing room. So, dealing room is actually where the dealing takes place. Back office is where the processing of deals, accounts, and reconciliation is done. Now, the third part is the mid office. Now, mid office deals with the risk management. It sets parameters of risk for the dealing room operations, including Forex transaction. So it acts basically as a check over the risks taken by the dealers and also supplements them by giving market information. Mid office is also supposed to look after the compliance of various guidelines, instructions, and is independently function. Now let's talk about various types of risk in how the dealing room is managed. Now, as per RBI guidelines, the board of directors of banks should frame appropriate policy and fix suitable limits for its forex dealing functions. The major risk associated with foreign exchange dealing room is operational risk, exchange risk, credit risk, settlement risk, liquidity risk, gap risk or interest rate risk, market risk, legal risk, systemic risk, country risk, sovereign risk. These are the number of risks which the foreign exchange transactions face. Now, let me quickly describe each of these risks in just one or two lines. Now, operational risk is a risk which arises because of human error, technical fault, infrastructure breakdown, faulty system, procedure, or lack of internal control. This is operational risk. Now, exchange risk is the most common and obvious risk in foreign exchange dealing rooms. It is basically because of the fluctuations in the exchange rate and when the mismatches occur in asset and liabilities and receivables and payables. Now, credit risk is a risk of loss which arises due to the inability or unwillingness of the counterparty to meet the obligations at the maturity of the underlying asset. So the other person who has to make the payment refuses or does not want to make the payment. That is credit risk. Settlement risk is the risk of failure of the counterparty during the course of settlement due to time zone difference between the two currencies to be exchanged. So settlement risk basically happens because of time zone differences. Liquidity risk is a potential for liabilities to drain for a bank at a faster rate than the assets. The mismatches in the maturity patterns of asset and liabilities give rise to liquidity risk. For example, you need 10 lakh rupees of fund to make payments, but you don't have that fund because the last day you gave the funds to some person who wanted it. That it will give liquidity risk. Now, gap risk and interest rate risk. Now, in the course of business, a bank buys and sells currencies for spot and forward value. So, it may not be possible for the bank to match its forward and purchase sales. Thus, if the purchase and sale takes place for different value dates, while the bank may completely stand hedged on exchange front, it creates a mismatch at a future date between its assets and liabilities, which is referred to as gap. So the risk arising out of adverse movements in implied interest rate is called gap risk or interest rate. Basically, it's interest rate differential. Now, what is market risk? Market risk arises due to the adverse movement of market variables such as exchange rate, interest rates, etc. Legal risk, which arises on account of non-enforceability of contract against the counterparty. Systemic risk is when the major bank falls or many institutions are facing problems. Country risk is due to the local government regulations or political or economic instability of the country. Sovereign risk is a sub risk in the overall country risk. Now, it can happen because of various situations in the country. Now, let's talk about RBI and FEDAI guidelines. Now, the Reserve Bank of India, being the central bank of the country and the custodian of national foreign exchange reserve, has prescribed guidelines for authorized dealers permitted by it to deal with foreign exchange and handle foreign exchange transactions. FEMA 1999 also prescribed rules for persons, corporates, etc. in handling foreign currencies as also transactions denominations. The Reserve Bank of India issues authorized dealers licenses to banks and all India financial institutions to undertake foreign exchange transaction in India. Now, money changer license to large number of established firms is issued by RBI. It is also issued to companies, hotels, shops to deal in foreign currency note, coins, and travelers' checks to facilitate encashment of foreign currency or foreign tourists. For example, a foreign tourist might want rupees, but he has dollars, so he can go to these money changers which are licensed by RBI. It can be a hotel, a shop that can exchange his dollar and give him rupee. Now, entities authorized to buy and sell foreign currency notes, coins, and traveler checks are called full fledged money changers. So, any entity which is authorized to buy and sell foreign currency notes, traveler checks is called full fledged money changes, while only authorized to buy are called restricted money changes. So, who can buy and sell, it is called full-fledged money changes, and only authorized to buy are called restricted money changes. Now, authorized dealers are also categorized as per RBI. Authorized dealer 1, 2, 3. Let's talk about FEDI, Foreign Exchange Dealer Association of India. It is a non-profit making body which was formed in 1958 with the approval of Reserve Bank of India. It consists of authorized dealers as members. FEDI prescribes guidelines and rules for market operations, merchant rates, quotations, delivery rates, holiday interest on defaults. In terms of RBI guidelines, all authorized dealers are members of FEDI, and it is mandatory for them to follow the guidelines directives issued by FEDI. FEDI guidelines also prescribe rules related to handling of export-import bills, transit period, crystallization of bills, and other related issues. It also advises RBI on market-related issues and supplements the effort of RBI to strengthen the foreign exchange market in the country. A few of the major FEDI guidelines rules are all export bills to be allowed a standard transit period. It is for the purpose of allowing concessional interest rates and calculation of notional due dates. Cancellation of forward contracts. All contracts which have matured and have not been picked up shall be automatically cancelled on the third working day after the maturity date. So any contract which has matured but has not been picked up will be cancelled on the third working day. This is FEDI rule. So in the event of delay in the payment of interbank foreign currency, interest at 2% will be charged. FEDI also prescribes code of conduct for Forex dealers which are dealing with the Forex brokers. So this is a very important concept which you should definitely be knowing. And I'm sure this chapter summary would have given you a lot of valuable insight on this important chapter. Now let me quickly ask some questions which you can answer in the description box below. Question number 1, foreign exchange markets are, I'll give you 4 options. You need to select one: regional market, domestic market, global market, or localized exchange and traded market. Out of the several factors, the following factors does not have an effect on the movement of exchange rate: political instability, increase in domestic interest rate, change in taxation policy, increase in domestic tourism. Okay. What does spot dealing in foreign exchange means? We have already talked about spot. The rate at which the quoting bank is ready to sell the currency is called. What is that rate called? Operational risk does not include. I'll give you 4 options: movement in exchange rate, human errors, technical errors, systemic failures. Question number 7, cancellation of forward contract is to be done at which rate the cancellation of forward contract is done? Okay. Crystallization of export bill is to be done as per what policy? Let me ask you certain fill in the blanks. Exchange rate denotes a dash at which one currency exchange for another. B. Foreign exchange markets are dash markets with no barriers. C. The currency appreciates due to inflow of overseas capitals if local interest rates are dash. D. Dash deals provide depth and liquidity to the market. E. Direct quotes are also called dash currency quotations. F. The part of dealing room operations which deals with risk management is called dash. G. Risk of loss arising due to the inability or willingness of the counterparty to meet its obligation is called dash risk. Dash guidelines are prescribed for conduct of dealers, brokers. So I hope this video would have given you valuable information, and I'm also sure that you have watched this video, and I would like to make you rest assured that you have reached a channel that will give you a treasure of knowledge, and that's a promise. So please subscribe and become a lifetime learner. And if you have reached at the end of this video, I'm sure you will certainly acknowledge what I have said just now. So thank you for watching this video. Have a great day. Bye bye.